it's actually a shame that this webinar is not better attended, because out of all the things, hey everybody, out of all the things, trader psychology, although it's not a sexy subject, is probably the most important subject we can talk about. Because anybody can, I feel like anybody can learn moving average and stochastic and what support and resistance is. I'm going to teach you that in about 4 hours, right? But trader psychology is the thing that ultimately separates one from success. And really today is going to be more of a reminder and due paying. And I recognize a lot of the names here, so this is probably falling on deaf ears because it's the intrepids that are here anyway. But like always, if you have any questions, fire away, and we can take this webinar wherever you want. So if we want to, we'll talk some trader psychology, we'll get it out the way, and then we can break down some charts and some things. It's an interesting market ahead of the FOMC tomorrow. Maybe I can give you my 2 pips on that. All right, so trader psychology. I'd like to start by a little story time. And I'm interested, in what everybody's feedback is here, because I feel like we go through the same things, but on an individual basis. So, this is my 12th year, 11th year of trading, going on to my 12th in a few months. I cannot believe it's been that long. I mean, it really has flown by. The great thing about Forex and trading in general is that no 2 days are the same, but they're all the same. It's always, it's one big soap opera, and a lot of that is dealing with oneself, isn't it? So, when I started trading, there were a couple of things that cropped up. Obviously, the first thing that one learns are the technicals and the basics of actually how to physically do the job. All right? Then it seems like you're chasing an ever-elastic target. In other words, if I am looking for 40 pips a day and I try to make those pips on 1 trade or 2 trades, a lot of times I would get stopped out for a loss, say 30 pips, and then it would go in my direction, and then I would end up losing money but being right. And I know that that is not an uncommon theme. So then what one does is you say, okay, well, I'm being stopped out by an average of 4 pips because I've logged this over 100 trades. I'm being stopped out by 4 pips. I'll just expand my stop by 5. And then what happens is that all of a sudden you are now taking 5 more pips loss, not necessarily being right more, but your losses have now expanded. So then you say to yourself, okay, well, if I was only getting stopped out by a pip and I was right most of the time, then why don't I just make it a very tight stop and then be right, and then just hopefully time my trades better? And then inevitably you find yourself micromanaging or spending more time at the charts, and that doesn't work. But you tend to know what you're doing, but you're still losing money. Anybody else attest to this? And what does that do? It literally makes one want to pull your hair out. Literally. I used to sit for 18, 20 hours a day, and now I'm bald. And some of that is genetics, and a lot of that is currency trading. All right? And in the solution to this is a sports analogy. So if you look at, I always use swimming, for example. If you look at a swimmer's build, they are very lean. You look at Michael Phelps, not to, as in getting seductive or suggestive here, we don't want to tread on this. But if you look at Michael Phelps' build, he's, broad-shouldered, V-taper body, lean, strong, etc. Very distinctive swimmer's body. If you look at a shot putter, they're generally stockier people. They about 300 pounds, and they spin in a circle and throw a big iron ball. All right. Michael Phelps's body he's been swimming for the last 30 years, and it's taken his body that long to look like that, to adapt to what he's doing. Okay, and the same thing can be said for the shot put. And if you watch cycling, if you watch the Tour de France, those guys weigh about 43 pounds. Yes, they're on enough EPO and testosterone to sink a battleship, but let's not get bogged down. All right, but the point is, for 3 weeks, they're cycling 200 miles a day, hard as they can, up through the Pyrenees and the Alps for no good reason, and carrying water around. And in return, their body responds by converting itself into, somebody who looks like they should go and get food relief in the Sudan. My point to this is trader psychology is no different in terms of its development in your mind. Okay? Meaning that the time it takes to develop this takes years. All right? And this is my fundamental problem with the Bitcoin crypto craze. Is literally everybody that encounters me now asks, what do you think of Bitface? And I tell them that they should invest every penny they have and lose every single dollar. And I'm saying that because this is going to come off very condescending and arrogant, and it really doesn't mean to be. If I was a swimmer and I trained 5 hours a day and Michael Phelps trained 5 hours a day, do I still have the right to go and beat him in the Olympics? No. Because he has literally changed his physical structure to allow him to swim like that. I haven't, despite my level of fitness. So my point to this is that, and I'm using these very strange sports analogies, my point to this is that there's a lot of due paying that not everybody is willing to do. All right? And most of that is just being around it long enough that the psychology becomes something that you are comfortable with relative to your trading style. Okay, so this has been the progression of my personal trading. When I started, it was the back end of 2006. I was still in the military. There was a period where I think the average daily range on the euro was about 140 pips. I remember it actually well, about 145 pips. I think pound dollar was upwards of 180, 200 pips. Pound yen, 250, sometimes 300. And this was consistent on an everyday basis. And it was consistent because of interest rate differentials and different central banking policy and central banks actually moving in their policy. And particularly the carry trade was on at that time. You'd look at it every day, and basically your question was, should I buy a yen denomination? Should I long Aussie yen? Effectively was the question of the day. Okay? And as a result, with just a few technical practices, it wasn't particularly difficult to make money on an intraday basis. There were some struggles, yes, but on an intraday basis, you could make 30 to 40 pips every day, and it wasn't that difficult. Enter 18 months later. The crashes start to happen, and it's just raining money out the sky. The question became, Should I short the yens? Yes. And so those ranges were absurd. 400 pips a day. Okay. Then sort of 2009-10 came along and the advent of QE, and things changed. I'm getting to a point here in a minute, so I hope you're sticking with me. And things changed, and the grind started. And things dried up. The euro dollar sort of ranged 60 pips a day. Pound, 90. So in other words, instead of having to capture 15 to 20% of the move, you'd have to capture like 80% of it and be right to make any money. And as a result, there was a lot of chop involved and a lot of very mixed trading. And as a result, a lot of broken confidence. How many of you have been on a golf course, you're striping it all day, and all of a sudden, a la Tiger Woods on the 16th on Sunday, you double cross yourself trying to cut one into the fairway and bang it OB left. And then the rest of the day, you're trying to not hit that one shot left. So you find yourself with a big fat cut to the right. So in other words, I started doing things that I wasn't comfortable doing out of the norm. But that's just trading. Okay? So then I developed the strategy of more of the fact that I felt that if it was cheap, I wanted to own it. And if it was expensive, I wanted to sell it. And it was a quantum leap in psychological bias. I'll say it again. So in other words, if you're going car shopping and you know a BMW M5 costs $100,000 and it depreciates, 20% a year, whatever, and you look at it and you say, the average car price is $50,000 for this 2015 M5, and it's been advertised for $42,000. Worst case scenario is I lose nothing if I buy it. And the same thing can be said for expensive things. All right, so instead of nickel and diming myself on an intraday basis, literally pulling my hair out that I didn't have, I all of a sudden had something that I was way more comfortable with in terms of it's okay to be less precise. In other words, I'm looking at the euro dollar, and while I am a dollar bear, I do think that the ECB is premature in their rhetoric to cut quantitative easing. So my nonsense detector goes off. I'd use a different word, but this is, a family show. And I say to myself, Draghi is ahead of himself. Okay? I also think the Fed is, the Fed's going to drag the heels. But I think that Mario is a little ahead of himself. And I don't believe that the European economy can stand on its own 2 feet. And I look at the subsidiary data like Spanish unemployment in the mid 20%. And there's still a lot of very toxic assets that they're holding on their balance sheet that are now reaching maturity, that they have to reinvest, etc. Now, a lot of that is going to be very positive for their stock market, but they're talking about fiscal restructurings. I don't know how they're going to impose massive fiscal structural changes on themselves. It's just going to be one big fight and a dog show for years. Okay, now has Europe, my best trade of 2017 was $1 short. Now, has Europe improved? Yes. Is it improving at a disproportional rate to the rest of the world? Yes. Is it premature to cut QE even though I don't believe in the wealth effect? Yes. Net result of that is I think the euro between 24 and 27.50 is expensive. And said differently, I think euro anywhere below 115 is cheap. So my strategy then becomes when it gets high, accelerates high at a certain rate, I will then look to sell it between 24.5 and 27.50. And let's say I'm trying to build my position size to 1 million with leverage, so 10 standard lots. I might put 250k at 24.50, another 250k at 25, another 250 at 26, and another 250 at 27 change. And that would hypothetically build my million, my 1 million size position. Okay, and what have I done? I've effectively said to myself, that's where I think euro is expensive. I'm going to sell it there, and I'm going to live with the consequences, and I think it's cheap around 115. Does this make some sense? And then obviously you can line up the technical things, and, you know, I mean, you look at euro and you've got a lot of stuff here. And it wouldn't be crazy to see it do something like that and then pretty, you know, jog back up there. Nonetheless, the technical side's irrelevant here. And I know that you guys are probably getting a little bit bored with this discussion, but my point to this is your trader psychology has to match what you are comfortable with as a strategy. You will not be successful if your psychology doesn't match what you believe in strategically. Does that make sense? And I cannot figure that out for you. Only you can do that. So for me, it was a case of moving to longer term, more investment style, trading the macro moves. I wasn't being consistent trading the intraday with my level of control that I wanted. I was too controlling. I would interfere with myself all the time and consistently lose money despite being right all the time. And as a result, I had way too many hours at the charts, losing money or income or making money, losing money, very inconsistent, until I realized that my strategy needed to change in alignment with my trader psychology, not necessarily the other way around. I don't think that we are who we are. I don't think that you can manipulate your trader psychology to necessarily match your strategy. So if you are somebody who likes that instant gratification and likes that instant money, then maybe intraday is good for you. If you're somebody who's willing to sit back and let it happen a little bit and pick, you know, very strategic levels and maybe phase yourself in to a point where you're not obsessed with being right on an immediate basis, then you should adjust your strategy accordingly. Okay, I hope that makes sense. And I know that's not really giving you a very sort of direct directive, but it's honestly the best advice I can possibly give you is to match those things up. Otherwise, I'm not sure that you'll ever be successful. You'll be participating in a sport you're not very good at. Okay, now the other thing I wanted to bring to your attention is this. And this is why I don't believe that this new crop of people all chasing cryptos have the right to make money. And that's, I know that's an arrogant thing to say. They just haven't paid their dues. It takes years. It takes years. You're not going to come and play in this arena from, you know, knowing nothing and think that just buying some stuff and it's just going to go up at infinitum is going to make you money. No, you're going to lose every penny. Okay, now I wanted to bring this to your attention too. Let's say you start with a $2,000 account. Okay, and you have a little trade plan that looks something like this. Okay, you say to yourself, what is my bias? And incidentally, this is my sort of very tentative way I look at things. What is my bias? And I'm talking a short term and a medium term. And when I say medium term, I'm talking it could be 3 weeks to 3 months. And short term, this might be 1 minute to 5 days. Okay, so what is your bias, long or short? All right, after that, it's a case of After that, it's a case of looking at the news. And I'm talking about a basic bias. For example, I am bearish on the S&P 500. Have been for a while. I don't buy the S&P. I only trade on the downside when I think it's expensive because that's my bias. All right, and I do that because I think that, and that's my bias for various fundamental reasons. I think that rates are going up globally. I think that the supply of free money is coming to an end. I think that companies are actually going to have to make money to go up in value. Tesla can no longer lose money, $7,000 on every single car they make and still go up in price. It makes no sense to me. I think that those days are coming to an end because the price of money is going up. And if the price of money is going up, it's actually going to cut into corporate profits like it should. And so those companies are going to have to compensate for that and actually make money. I know it's a crazy concept. I'm talking bonkers here. All right. And as a result, I think that 2,800 takes us down to 25, and that's my bias. So I trade in that direction. All right. So then I look for news, what's going on for that week, and try to trade around that. Okay. And then the technicals, whatever your strategy is. Whoopsie. You know, what are your technicals? In other words, where's your support and resistance, etc. Okay. And then I figure out the risk. And risk includes, I don't use stops, but if you use stops, where are your stops? And your position size. Sorry, these are all abbreviations, probably have no idea about. Okay. And then, figure out how I'm going to execute it, whether that's with an order, whether I do that at market, whatever. Okay. What's it going to do? Right. Now, this process takes a little while. Okay, you've got to do the analysis for the technicals, you've got to do the analysis for the news, you've got to do the analysis for the bias, you've got to figure out your risk, and then you've got to strategize a little bit for your execution. Okay, now, sometimes one has to really grind over these things. Okay, what is this looking like? So let's say you look at, I don't know, let's say you look at Aussie dollar right now. And you say to yourself, I think that Asia's lagging a little bit, blah, 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 blah. I want to potentially short the Aussie at 77.60 and try and take it down to 76.20. Okay, 77.79 is the weekly central pivot. You have the 21 EMA on the 4 hour steeply down, intercepting that. So it's likely to hit that and continue down. 76.08 is the weekly M1. Seems like a reasonable target. Split the difference there. Call it 76.10. Okay, so the technical, the trade there then becomes 77.40 for 76.10. Okay, and let's say it takes you 2 days to set up. And you've been thinking about this Aussie trade for 2 days. And for whatever reason, it comes to your level, and you short it, and you got the sweaty palms, and you got all the things. Okay, and you're nicely in profit, and you decide to trail your stop, and it turns out that you make, I don't know, let's say you traded, I don't know, 20K on this. Okay, and you were nicely in profit, but it bounced back, and for whatever reason, you got out and you made 20 pips. Okay, in other words, you made 40 USDs. Okay, you made $40, which by my calculation is 2%. Okay, now is this a bad result. No, it's a great result. You were looking for 100 and something, but you got out with 20 pips and you made 2% on this trade. It took days to set up. It took blood, sweat, tears. Days. Okay? And you made $40. If I went to work for McDonald's, particularly in California where minimum wage now is 15, I went to McDonald's and I flipped, Chick-fil-A burgers and Big Macs. After 5 hours, they would pay me $60 after taxes. And I was flipping burgers. I wasn't committed to this Forex thing and learning about fractals. But Mac time, a week, let's say I earn $400. Okay? And let's say here in Forex, you're grinding for hours and hours and hours on your $2,000 account. And you make, I don't know, $200 by the end of the week. $200. Half of what you did at McDonald's, you worked quadruple the hours, was stressful as heck, and you made $200. That is 10% here. So, point being is, have you failed at your Forex quest? No, you've been wildly successful. Why? Because you've concentrated on the process of making yourself wildly successful with dedication to the process. Yes, you could go to McDonald's and earn $400, but here in trading, it took, 54 hours for the week to make this $200. So on average here, you made $15 an hour. And here, earning your $200, you made $4 an hour. Okay, $4 an hour, but you made 10% in a week. By all accounts, if you made 10% in a year managing clients in Morgan Stanley, they would buy you a Bentley and parade you around in front of, if there was a veterans parade, you would go in front of it as the headliner. Rihanna would be behind you. Okay? Now, my point to this is this. Next week rolls around, and your first trade, you take a minus $40 loss. Okay, minus $40. So you essentially lost about 1.7% of your account because your account's now grown. Okay? And for whatever reason, your next trade goes break even. And all the time, you've now invested the better part, let's say, of 16 hours in the process. And in 2 trades, you've gone minus 40, break even. Next trade comes around, you lose another $40. Okay? Your trade account now sits at $2,120. And you've now invested 20 hours on this for the week. And you have lost $80. Okay? You are still up in this account the better part of 6%. By all accounts, successful. Alright? However, you're growing frustrated because now you're getting a little bit timid. You've break even on 1, you've lost 2, not looking so great for the week. So your next trade, this process, this whole planning thing, you're like, you know what? Euro looks like it's going up. I'm going to long it. You've not recognized your bias. You've not adapted to news. You've not looked at your technicals from every angle imaginable. You've not worked out your risk. And you've not executed in a patient manner. All right? And what happens? the inevitable happens. You don't do your due diligence and you lose $100. And before you know it, you slapdash and your account is at $1,800. I know that you guys have been here. I know it. I know this for a fact because I did this time and time and time again. Now you've got to make the better part of 15% just to get back to break even. Right? Anybody else been here? I know that it's not just, I know I'm not just talking to myself on this. And then inevitably, it's too much of a mountain to climb, and your account is $1,200. But it's not about the money at this point. It's about the fact that you abandon your process. And this is about how you develop trader psychology, is by doing the same thing in a diligent manner over and over and over and over and over again. And eventually that then becomes second nature and it becomes the ingrained habit. Okay, so let's say you're a sniper in the military. Okay, and they have tasked you with watching this road. Okay, and you are lying on your stomach here for 4 days. And the guys that are with you are not particularly enjoyable to talk to. They're all blunt force instruments and not very smart. Okay, and your maximum range you can focus on is this. That is what you can actively kill. One second. So, just getting back to my little analogy here. You guys are awfully quiet, so I'm just assuming that somebody's listening. All right, so if this is you as a military sniper here, and this is what you can actively hit on this road. Okay, but over here, you see somebody that's doing something naughty. Can you have a crack at this guy? Sure. You might tag him, you might not. But if you don't, he runs into the village and he rounds up 40 of his friends. And then he comes back with 40 of his friends, and there is a video getting sent to your family of very bad things happening to you. And I'm using an extreme example here. Trading is no different. Okay? You can have all the best plans in the world, but if you're not patient enough for those things to fall into your trap, you might make money sometimes, but you're going to lose money more times than not. And it's not about the money. It's about what it does to you psychologically. It brings doubt. You're frustrated with yourself. Yes, you lose money, which puts a burden on your further trades. You've taken a loss that now you have to compensate for elsewhere, which puts additional pressure on you that you have self-imposed. Okay, so the bottom line here is that discipline is as much integral to building your trader psychology as anything else, because ill discipline will not only lose you money, it will disrupt your psychology that you're building for yourself. So the message is this. It's stay true to your process, because that is the quickest way to build a sound trader psychology base. Because then if you are doing If you have a diligent process, then when things go well, you can document why they're going well. And if they're going poorly, you can make adjustments because you have a baseline to work from. If you're ill-disciplined and you're trading and trying to shoot stuff outside your scope, then you don't know really, you just know that you're an idiot. You don't really know anything further than that. So my point is exactly that. I don't care if the net result is you're earning $3 an hour being the most fastidious trader in the world. It's not about that. It's about developing the trader psychology over a 24-month period that's going to propel you for the next 24 years. And I think it's those people that are willing to pay those dues that are going to be massively successful, because their $2,000 account will then become $5,000 and $10,000 and $20,000, and then they can round up their friends, and their friends give them 50, and then they can trade their money, and before they know, they're managing $10 million. Okay. I hope this was helpful. It's all very self-explanatory stuff, but sometimes we just need a little reminder about discipline and trading, because without it, you're done. You might as well, I don't know, you might as well go outside and just walk the dog. Any questions on this? Anything else you want to discuss? Let's quickly, while we have a minute, let's quickly talk about FOMC tomorrow. It's the first Fed meeting. I don't think that Powell can say anything crazy. One, because Donald Trump fires you on a whim. Just 2 days before your 2 days before your FBI retirement, you just get the axe and lose your entire retirement you've built up over 30 years. Seems capricious, but hey, you're fired. So, in other words, I don't think that Powell, although the Fed is meant to be an autonomous and exclusive thing, it's not meant to be political, they are extremely political. And I don't think that Powell can say anything that's going to ruffle any feathers. So my guess is that the Fed situation tomorrow is very volatile and completely uneventful. I am a short-term dollar bull. When I say short-term, I'm talking over the next 3 months. And then I think the dollar destruction will continue on the back end of the year. But we need something to get short the dollar more. We need something around the 130 range for the pound, and anything below 115 on the euro. Trying to take the 130 to 160 on the 130 for a 160 target on the pound, and kind of a 113, 114 long on the euro, looking for 130 there. And obviously those are long-term propositions. And for the time being, I'm trying to get long the dollar, just to take it down to those levels. So it'll be kind of traded down, and then I'm going to try to hold some things up on the pound and the euro on the long-term basis. But I mean, that's really, I've just given you like the 18-month plan on those two major currencies. Yeah, I think you're right there. Absolutely. And trading's one of those things that really will expose you as a human. We don't want to get particularly philosophical here, because it is just trading, but it becomes a personal affront, doesn't it? Because it's about self-discipline, and the market will show you ill-discipline. It'll expose you in about 4.5 seconds. And then then one gets self-critical about your intelligence and aptitude and doubt and all the things. And that's why it takes a long time to build it up. So if you are in your first 12 months if you're in your first 12 months or even your first 24 months, you're still building, the brain, the gray matter between your head. And until that's built, being successful is very difficult on a sustainable basis. And the only way to do that is to stay militantly disciplined to your process. If you deviate, you'll destroy your very fragile psychology, and then you've removed your baseline, you have nothing to work from, and all you're dealing with then is doubt. And inevitably you'll start cherry picking trades, and the cherry picks that you take, you'll leave the good ones and pick the bad ones, and you have to be able to take absolutely every opportunity for the averages to pay off. Anyway, I hope this was helpful, everybody. And if you have any questions, you can reach me on the twit at ForexDavid, FOREXDAVID, or on the emails at c5davidpegler@yahoo.com. And good luck. Reach out if you need anything. Thanks.